Have you ever really stopped to think about what happens when a company goes public? It's more than just a ticker symbol flashing on a screen. Today, we're going to pull back the curtain and look at the legal playbook that transforms public interest into actual hard capital.
Right, so when a company decides it wants to use your money to grow, they can't just, pass a hat around. There's an entire rule book they have to follow, a whole process designed to make sure investors are protected. So let's crack open that rule book and see what it actually says.
So, where does it all start? Well, it begins with a formal invitation. And in the world of finance, this isn't just any invitation. It has a very specific name, the prospectus. This is the moment the company officially makes its case to you, the potential investor.
Think of it this way. Basically, any notice, any ad, any document a company puts out there that asks the general public to buy its securities, the law considers that a prospectus. It is the company's official, legally binding pitch for your investment.
Honestly, the best way to think about it is like a super detailed dating profile. It has to lay out everything, and I mean everything. Its business model, its financial health, all the potential risks, and exactly what they're going to do with the money. The entire point is transparency, so you can make a smart, informed choice. And, not all prospectuses are created equal. A shelf prospectus, for example, is kind of like getting pre-approved for a loan. It lets a company raise money multiple times over a year without starting from scratch each time. Then you've got the red herring prospectus. That's the draft version for an IPO where the final price is still a big question mark. And finally, the abridged prospectus is basically the short and sweet summary that comes with the application form.
Okay, so a company is using this one document to ask for millions, maybe even billions of dollars. How on earth do you know you can trust what's in it? Well, that brings us to the single most important principle in this entire game: investor protection.
This isn't just a friendly suggestion, it is the absolute bedrock of the law. The whole system would collapse if companies could just lie. That's why any misleading statement, or just as importantly, leaving out a critical piece of information is a huge deal with very serious consequences.
So what happens if that corporate dating profile is full of lies? Well, the law doesn't mess around. It comes at the problem from two different angles. One that's about money and another that's about personal responsibility.
And you can see the two sides of the coin right here. On one side, you've got civil liability. That's all about making investors whole again. The people responsible, directors, promoters, have to pay you back for any losses. But then look at the other side, criminal liability. That's not about money. That's about punishing fraud.
And we are not talking about a slap on the wrist. If it's proven that a prospectus was intentionally fraudulent, the people who authorized it could face up to 10 years in prison. Not to mention fines that could be 3 times the amount of money they raised. It's serious stuff.
All this legal talk, it might sound a bit dry, but it's not just jargon, it's your safety net. It's the entire system that gives you the confidence to put your hard-earned cash into a company, knowing that the story they're telling you is supposed to be the truth.
All right, so the prospectus is legit, you love the company's vision, and you've decided to invest. So what do you actually get for your money? You get a piece of the company itself. You get shares. A share is so much more than a number on a screen. It's your legally recognized slice of the corporate pie. It means you own a tiny little fraction of everything that company owns and everything it might earn in the future. It's your official badge of ownership.
Now, getting those shares isn't like buying something off Amazon. It's a formal process called allotment, and it has strict rules. But check out this last one, the minimum subscription. This is super interesting. If a company can't convince enough people to buy at least 90% of the shares it's offering, the whole deal is off. Everybody gets their money back. It's a fantastic built-in safety valve.
It's funny, not that long ago, you'd get this fancy physical paper certificate proving you owned a share. Today, it's pretty much all digital. Your shares live electronically in something called a demat account. Just think of it like your online bank account, but for investments. It's way faster, way safer, and lets you trade shares instantly.
Okay, let's talk about the actual people involved in this whole story. The law uses some very specific terms for the key players, and it's easy to get them mixed up. So let's take a second to clear up who's who.
First up, the promoters. These are the visionaries, the founders, the people who get the whole thing off the ground. And because they have so much power at the start, the law holds them to something called a fiduciary duty. It's a fancy term, but all it really means is they are legally required to act in the company's best interest, not their own. No secret side deals, no hidden profits. Period.
Now, here's a classic point of confusion. We use the words member and shareholder almost like they're the same thing, but legally, there's a small but crucial difference. A shareholder is anyone who owns shares. Simple enough. But a member is someone whose name is actually written down in the company's official list of owners. Think of it this way. Anyone can hold a ticket to a concert, but you're not officially on the guest list until your name is in the register. That list is what really counts.
So the money's in, the shares have been allotted, but the story doesn't stop there, not even close. A company's share capital isn't set in stone. It's a living, breathing thing that companies actively manage for all sorts of strategic reasons.
With just a simple majority vote from its shareholders, a company can tweak its capital structure. They could create more shares to raise more money, or they could do a stock split to make the share price lower and more attractive to smaller investors. It's all about flexibility.
But reducing capital? Whoa, that is a whole different ballgame. Why? Because reducing capital could mean paying money out of the company and back to shareholders. And that means there's less cash left to pay back creditors, like banks or suppliers. That's why it needs a supermajority shareholder vote and a judge's approval to make sure nobody gets left in the lurch.
One of the most common ways a company returns cash to investors is through a share buyback. It's exactly what it sounds like. The company uses its own cash to buy its own shares right off the open market. This reduces the number of shares out there, which tends to push up the price for everyone who's left. It's also seen as a big vote of confidence for management in their own company.
And of course, there have to be rules, right? A company can't just go wild and buy up all its own stock. The law puts a cap on it. A buyback can't be more than 25% of the company's capital and reserves. This makes sure there's still plenty of money left to, run the business and pay the bills.
So after all of this, what really is a share? Is it just a number that bounces up and down? Or is it a piece of a story that has rules? As we've seen, it's definitely the story. When you buy a share, you're not just making a bet, you're stepping into a legal relationship, one built on the simple but powerful ideas of fairness, transparency, and trust.